Good morning, everyone. Welcome to our group's presentation. Today, we would like to present the topic, the reality of convertible bond issuance in Vietnam. There are 5 members in my group, including me and Quân, the leader of the group, Đức Anh, Tấn Pháp, Xuân Trà, and Doãn Ngọc Vy. There are 9 distinct parts in our presentation. The first one is the definition of convertible bond. The second one is the history. The third one is characteristics. Next is the classification, the pros and cons of convertible bond. The sixth one is the effect of convertible bond issuance on the economy. The seventh one is the regulations of Vietnamese government on the issuance of convertible bonds. The next one is the trading of this kind of bond in Vietnam. And the last one, our group would like to give several conclusions and recommendations. So now, let's move to the first part of our presentation, presented by Doãn Ngọc Vy.
First one, I will tell you what is a convertible bond. A convertible bond is a fixed income corporate financial investment that may be converted into a certain number of shares of common stock or equity. During the bond's duration, conversion to stock is feasible at particular intervals and is frequently at the bondholder option. Next one, what is the history of convertible bonds? It begins in the 19th century when American railroad firms required financing to fund their commercial operations. It was difficult to raise capital by issuing shares or bonds. Another financing option, the convertible bond proved appealing to business and investors alike in the hedge fund for funds. By having the option to convert bonds into shares, investors might take advantage of growing equity prices in the U.S. growth market, or receive the investment back in the form of coupons even if the share price declined. The first convertible bond listed on the stock market in Vietnam was the convertible bond of Vietcombank, successfully issuing convertible bonds with an average interest rate of 6% per year in December in 2005. Vietcombank raised 1,365 million VND. Although the Vietnamese market for convertible bonds has so far shown signs of growth, it is still the most modest in comparison to other investment portfolios like those for banks, gold, or equity. There are 4 characteristics of convertible bond. It is defined as a firm's debt security that paid fixed interest but could be exchanged into a pre-decided number of common stock or ordinary shares. That is why convertible bonds are usually callable. Secondly, the price of a convertible bond was extremely sensitive to changes in the underlying share's price, the credit rating of the issuers, and the interest rates in the hybrid security. A convertible bond cannot be divided into separate securities and has no internal maturity date. Thirdly, a convertible bond's value is its option value at the maximum of its straight bond value and its conversion value. A convertible bond's price that cannot be converted into ordinary shares is known as its straight bond value. It only relies on the risk of default and the general interest rate level. And the last one, the design elements of convertible bond are determined by the convertible securities issuer such as conversion price, conversion ratio, call provision, or time maturity. And next one, I will tell you about the classification of convertible bond.
Thank you, Doãn Vy. Now is the fourth part, the classification of convertible bonds. So we have 8 convertible bonds. The first one is vanilla convertible bonds. This is the simplest convertible structures, and this is type of convertible bond is the most popular and typically offers the asymmetric return profiles and positive convexity that are incorrectly associated with the entire asset class. Secondly, mandatory convertible. These convertible bonds are the popular version of vanilla subtypes, especially on the US markets. Mandatory convertible, as the name suggests, would compel the holder to convert into shares of maturity. These assets would frequently have 2 conversions price, which would be comparable to the profiles of the risk reversal option strategy. The first conversion price would set a ceiling for the price at which investor would get share value as their bar, while the second would set a ceiling for their potential profit over bar. Thirdly, reverse convertible. A less frequent variant, reverse convertible are typically issued synthetically. The conversion price would serve as a knock-in short put option. As the stock price fell below the conversion price, the investor would start to be exposed to the underlying stock performance and would no longer be able to redeem the bond at bar. This would be the opposite side of the vanilla structures. Welcome to the fourth convertible bonds. This is the package convertible bonds, often known as the bond plus option structures. These bonds are mostly straight bonds that have a call option or warrant wrapped around them. The investor might then typically trade each leg independently. The package convertibles would then have different dynamic and dangers since the maturity the holder would not receive some cash or shares. Now let's come to the 4 last convertible bonds. Firstly, we have contingent convertibles, a kind of mandatory convertibles if a pre-specified triggers event occurs, such as when the values of company asset falls below the values of its guaranteed debt, they are immediately converted into stock. Foreign currency convertibles any convertible bonds which face value is issued in a currency different from the issuing company domestic currency. Exchangeable bonds, convertible bond with the issuing and underlying stock corporation as separate business. Lastly, we have synthetic bond, a synthetically structured convertible bond with a payout that mimics a convertible payoff on a certain underlying equity was issued by an investment bank. For example, we have Barclays Bank BLC is an issuer and Microsoft is a reference underlying equity. This is the end of my part. Now let's come to the fifth part, the pros and cons of convertible bond, which presented by Xuân Trà. Welcome, Xuân Trà.
Thank you. And now I'm going to talk about the pros and cons of convertible bond. The first one is for issuing firms. There are several benefits for issuing firms when issuing convertible bonds. First of all, compared to an equity or share offering of the identical size by an identical enterprise, the offering of a convertible bond is regarded as positive news and is viewed with a less unfavorable announcement effect. This occurs because a significant increase in the number of stocks on the market is avoided and stock prices are rarely depressed. a convertible bonds conversion option lowered issuance costs while assisting in the management of the overinvestment incentive. The cost of issuing convertible bond is less expensive when compared to the cost and interest rate when issuing a regular bonds and bank interest rates. This lessens the convertible bond issuer risks while raising share capital and the company's value. Lastly, when no alternative funding instruments are available, managers issuing straight debt, raising the likelihood of bankruptcy, and performing the value-adding projects. Managers can also minimize the risk of bankruptcy by instead issuing callable convertible bonds. However, a number of drawbacks could be predicted. Whenever the bonds were converted, the equity were diluted by the rise in the number of outstanding shares. Thus, each share indicated a smaller percentage of proprietorship in the firm. This might have a negative impact on the share price and also the EPS, which means the earnings per share dynamic. Furthermore, the conversion will lower interest expenses, increasing the company's taxable income. As a result, the corporation must pay extra tax on the conversion. Additionally, the after-tax interest on the convertible bond is greater than the future dividends present value payable on conversion. Finally, if the underlying share performs well, the corporation is worse off having issued a convertible bond than straight debt. And secondly, I will talk about the pros and cons of convertible bond holders. In terms of merits, a fixed interest income is the first advantage. Convertible bonds have a fixed rate interest payment and will be repaid for par value at maturity, whereas the return on shares over a particular time horizon remains unpredictable. The second advantage is the given priority in the situation that a corporation declares bankruptcy and is liquidated, since holders of convertible bonds will receive the recovery value in the case of default. And the last benefit is the right to choose and potential gain from conversion. If the stock price drops below the conversion price when they will not exercise the conversion right, they will not experience significant losses. And that's the end of my part. Welcome Đức Anh. He will talk about the effect of convertible bond issuance on the company.
Thank you, Xuân Trà. I will talk about the effect of convertible bond issuance on the company. Convertible bonds have been issued and utilized in many countries around the world. Through scientific studies, many scientists have demonstrated the positive and the negative effects of convertible bonds on a company's performance, depending on the country, time, and industry that are taken into consideration. As you know, convertible bonds can reduce agency expenses and tax obligations prior to the conversion, which benefits the corporation, and it helps the business to achieve the goal of lowering leverage. Businesses may exaggerate their success and then change their image once financed. However, this would raise the cost of debt for the company. The impact of convertible bonds after they are issued cannot be withdrawn within a year because they are a built-in equity product. Convertible bonds are also significantly impacted by the equity structure and the high level of stock concentration due to changes in asset structure and management efficiency, which may have an impact on the degree of financial constraints following company financing. And below, there are three research that we found out. The first one, effect of the issuance of convertible bonds on a company's agency costs. which conducted an empirical study of the agency cost of 79 non-financial listed firms in China that issue convertible bonds between 2002 and 2013, looks at whether or not it is advantageous for listed companies to issue convertible bonds. The second one is the effect of issuing convertible bonds from the perspective of ownership structure, evidence from listed companies in Shanghai and Shenzhen, which listed businesses in Shanghai and Shenzhen served as the research subjects, and the ownership structure served as the beginning point. And last but not least, empirical analysis of impact of conversion of convertible bonds on corporate performance of different industries in China, which study the effects of convertible bond conversion on the corporate performance of various industries in China using the methods of principal component analysis and the Wisconsin's slide rate. Next, I will talk about the reality of convertible bond issuance in Vietnam. We move to the first section, the regulations of the Vietnamese government on the issuance of convertible bonds. Convertible bonds are issued by choice stock firms, and bonds purchasers are professional securities investors and strategic investors with a maximum of below 100 people. The issuing convertible bond has to be separated by at least 6 months from the end date of the most recent issuance. The conversion of bonds into share of stock must comply with the laws regulating the foreign investors' ownership ratio according to Decree number 153 in 2020. The plan for the private placement of convertible bonds must be approved by the general meeting of shareholders. Companies offering private placement of bonds must register and deposit bonds within 5 working days right after the State Securities Commission announces receipt of the report on the results of the private placement of convertible bonds from securities companies. Next, convertible bonds shall only be traded between professional securities investors and strategic investors who must be limited by less than 100 people after the transfer restriction period. Exception occurs in circumstances of compliance with legally effective court judgment or decisions, arbitration decisions, or inheritance as provided by the law. So, Quân will continue the presentation.
Thank you, Đức Anh. So now I will undertake two last parts of our presentation. The first one is the trading convertible bond in Vietnam. In the contemporary era, convertible bonds in Vietnam have made certain changes thanks to the development and integration with the world economy. However, for a number of reasons, convertible bonds are still not popular in Vietnam and have made certain differences from the word convertible bond. First and foremost, there is no credit rating for our bonds. As a result, figuring out the credit risk and credit spread to use as the foundation for the bond valuation discount rate is challenging. Due to a lack of market demand, our efforts to establish some credit rating companies have not been successful thus far. The lack of a legal framework governing the credit rating for the issuing of bonds to the public limits both the market's transparency and the demand for a company's credit rating. The second one, the conversion price of most convertible bonds issued by businesses to current shareholders is quite beneficial, typically at par. This implies that the intrinsic value of stock option is relatively high. The interest rate paid on bonds is not significantly less than the interest rate that businesses use to raise capital. And last but not least, the majority of convertible bonds have incredibly brief convertible maturities. Vietnam's convertible bonds frequently have a relatively short actual convertible duration, typically less than 1 year, in contrast to the worldwide convertible bonds, which typically have return rate of 5 to 10 years. So I will give you an example of a company in Vietnam issuing convertible bond that is patriotically make group commercial joint stock bank. There are three reasons why this bank decided to issue convertible bond. The first one is to ensure the legal capital according to the regulation of Prime Minister in Decree 14 2006. On the listed of the legal capital of credit institutions is at least $3,000 billion at the end of the year 2010. The second one is that this company wants to bring the best benefits to the bank and reduce the burden on shareholders in the capital increase roadmap for the period 2009 to 2010. And last one, they want to diversify the capital sources, increase the capital mobilization, expand the lending scale, and develop a network to meet customers' needs better. So the last one of our presentation is the conclusion and recommendation. Investors in Vietnam face a variety of risks because of the characteristics of convertible bonds with a shortage of credit institutions, serving as the main contributor. To enable them to make wise investor choices, business must actively boost the availability of information regarding the capital raising plans that could affect convertible bonds. The only way to ensure interest of investors and consistently build and enhance the public faith in the company is in this manner. And last but not least, the government should also research the rules against share dilution, which is considered as one of the most significant factors that exert an adverse impact on the bond in Vietnam. And it is also the end of our presentation. Thank you so much for listening.